Hello, I'm Jared Nelson from the Investing Channel, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. After a period of sustained euphoria, parts of the market are now gripped by fear. In the bond market, there is fear of inflation. For some growth stocks, it is the fear of rising interest rates. Perhaps you have already seen the sea of red in the electric vehicle sector. Industry leader Tesla is down around 35% from its January peak at $900. Fear in these growth stocks are dragging down even those blue chip companies like Apple. Its share price dipped below $118 for the first time since November, despite announcing record profits just recently. Others, like Adobe and Amazon, are seeing nasty downside breakouts below their major range support levels. Meanwhile, a large number of small-cap stocks that went ballistic earlier this year, sectors like pot, 3D, crypto, biotech, new energy, all saw prices correct by 30% or more. Even gold, the safe haven asset, is breaking down as the US dollar rallies. So, all in all, the sharp correction in growth and haven sectors is raising questions about the cyclical rally from March 2020. Is it over? No would be our answer. Last week, we talked about financials being one of the emerging market leaders in an era of rising rates. This view remains intact. As tech and other growth sectors sink, banks and other financial firms are holding relatively firm. Check out the iShares Financials ETF with the ticker XLF. Prices are near its all-time highs. Of course, you cannot rule out further weakness here as the market sentiment deteriorates, but we continue to suspect that financials are likely to outperform the market. Apart from financials, are there any other sectors that we favor? Yes, there is, and that is Japan. A couple of weeks ago, news was flashing about the Nikkei 225 index touching 30,000 for the first time since August 1990, a full 3 decades ago. It was a milestone achievement. Can you imagine NASDAQ or Dow staying low for the next 30 years? That's how long it took the Japanese benchmark index to reclaim the ground lost during the post-bubble years. A cyclical rally tends to make new highs. In Japan, we think the rally has further to go. One reason is that the local stock market is no longer filled with overpriced banks or property stocks. At its peak in 1989, the average price-earnings ratio in Nikkei was about 60 compared to 40 during the NASDAQ bubble. Those days are long gone. Instead, the Nikkei now is a mixed bag, filled with Uniqlo, SoftBank, Sony, Toyota, and Fanuc. No $1 trillion stock in the market, and no hyped-up stocks like Tesla. Another important factor for buying Japan is due to the support coming from the Japanese Central Bank, or BOJ. Over the past few years, the BOJ has been amassing large quantities of Japanese stocks and ETFs. Its policy is to buy about 6 trillion yen worth of ETFs every 12 months. Did you know that the BOJ is now the biggest shareholder of the Japanese stock market? Few other central banks support the stock market like the BOJ. According to some reports, BOJ holds a stock portfolio worth about $430 billion in late 2020. This holding is even larger than the Japanese government pension investment fund. When the stock market dives, you can be sure that the BOJ will print even more money to buy more ETFs. For American investors, buying Japanese ETFs is one way to ride on the Japanese recovery play. One ETF we have in mind is the iShares Japan with the ticker EWJ. The fund has about $13 billion of assets under management and tracks the MSCI Japan Index. Trackstar IQ, our proprietary search tracking tool, shows us that 6 institutional investors have checked out this ticker 12 times over the last few days. Chart-wise, the fund just broke out of its massive long-term resistance at 65. Any setbacks into the low 60s is potentially worth accumulating. Another attractive feature of the fund is that industrials and consumer discretionary stocks make up 38% of the ETF. These sectors may hold up better than more highly priced tech stocks. Of course, in stock markets, anything can happen. The 10-year Treasury yield may spike to 2%, or the NASDAQ may crash, or investors may take fright and sell all foreign stocks. Demographically, Japan is not looking good, and the country's debt pile is growing too. But we stretch our view over 12 months and look over the current market route. A sector rotation is clearly taking place amidst a strong equity bull market. Japan may well benefit from this rotation. We expect the Nikkei index to test its previous peak at 39,000. That's all we have time for this week. Before you make any investment decisions, please ensure you do your own due diligence. To find out more about our TrackStar IQ data, sign up to our free newsletter at investingchannel.com/TrackStar.